Okay, starting January 31st, the student loan forbearance that you've been on since March of 2020 ends. What are you going to do about paying these student loans? I'm going to tell you about how you can reduce your student loan payment or have none at all. Stay tuned. Okay, so if you're new here to this channel, go ahead and hit that subscribe button and click that notification bell so that you're the first to see content from us when we post every week. If you haven't watched the student loan forgiveness video, check that out now and then come back here to see which one is a better deal for you. So for many of the people who are paying student loans, you've had a reprieve, a break from it since March 2020. And it's coming back again. Oh no, you got to figure out how you're going to pay this extra bill. For some of these people, it might be almost as much as their mortgage. But we're going to talk about how you can possibly reduce that payment and get back into the swing of things. We don't know what's going to happen. They may extend it, they may not. But you want to make sure you plan in the event that you have payments due starting in February. You don't want to be in a position where you don't know how you're going to pay it for February and get behind. So let's talk about some of the options you have for yourself. Okay, so if you have federally held student loans, you may qualify for an income-driven repayment plan. And this is different from your standard repayment plan, which is based on your actual loans. It actually considers what you make and factors in how much your monthly payments will be. And so there are 4 different types of income-driven repayment plans, and I'm going to talk about the pros and cons of each of them. And some of them may help lower your payments and not necessarily extend the life of your loan. So it may be something that will be of benefit to you because it helps you get a lower monthly payment, but doesn't say, okay, you're going to be paying it for 50 years as well. So let's talk about the 4 different income-driven repayment plans. Okay, so the 4 repayment plans are revised pay-as-you-earn repayment plan, pay-as-you-earn repayment plan, income-based repayment plan, and income contingent repayment plan. So there are 4 different ones, and depending on what your financial situation is and what your family size is, you'll see which one works out best for you. So I'm going to explain a little bit about how the monthly payments differ for each of them, and then you can actually apply for any of these, and I would say do it now before the January 31st deadline so that it already can be in effect when your payments start on February 1st. Unless something else magically happens between now and then. Okay, so if you apply for the revised pay-as-you-earn repayment plan, your monthly payment is going to be, on average, the 10% of your discretionary income. And discretionary income is defined as what your annual income is minus what the poverty level is for your family size in your particular state. And so when you do those calculations, you got to see what your payment amount would be. In some instances, you may not owe any monthly payment if your annual income minus the poverty level, it leaves you with nothing. You have basically no discretionary income. And that would be something that you have to cross that bridge when you get there. But in that instance, you wouldn't have any payments due, but you would be under a plan that still counts it as a payment as far as counting how many payments you made for the life of the loan. You don't have to pay forever. And so if you're on a particular plan, and the plan doesn't require you to make any payments, but it counts as a payment, then that's a go for you. But you have to be qualified and approved for that plan before you just say, oh, I don't owe anything because I did my calculation. You actually have to apply for the particular plan. So do your little quick calculations and figure out if the revised pay-as-you-earn plan would be a good plan for you. The pay-as-you-earn and the income-based repayment, if you're a new borrower, they also have 10% of your discretionary income as your monthly payment. And there's a cap at, it can't be more than whatever the 10-year repayment plan is for the standard plan. So if you have either pay-as-you-earn or income-based repayment and you're a new borrower, then it won't be more than 10% of your income. If you are an old borrower, so a new borrower is defined as anybody who took out loans after 2014, July 2014. If you're an old borrower, then the income-based repayment plan is 15% of your discretionary income. And like I said, I define discretionary income as regarding your family size and the poverty level in your state. If you're an income-based repayment and you had loans prior to 2014, then it will be 15% of your discretionary income. The last income-driven repayment plan is the income contingent one. And your monthly payments will be either 20% of your discretionary income, or what you would pay on a repayment plan with a fixed payment over a course of 12 years, whichever one is less. So you can pay either one. Remember I said that there's a cap on how long you're going to pay the loans. It's not like, oh, I'll be on these loans, I'll be paying these loans forever. If you apply for these income-driven repayment plans, they do have a cap on how long you're going to pay for it. So like I said, make sure you apply for those plans so that you're not calculated under a different standard plan and it's like you pay forever. But for each one, there's a cap. So for the repayment, the revised pay-as-you-earn is 20 years for the undergrad and 25 for professional studies. For the pay-as-you-earn is 20 years. For the income base is 20 years. And for income contingent is 25 years. So at least you can see the light at the end of the tunnel. I mean, those are a long time to be paying for things. But as I mentioned before, if you haven't checked out the student loan forgiveness program, you may actually qualify for those. And those are for 120 payments. You'll be forgiven after 120 payments, and that's 10 years. So you might be missing out on some free opportunities to get out of these student loans that just about everybody in the country is dealing with. I'll leave information in the description box about the programs I talked about and how you can apply for them. It depends on who your servicer is. That's how you have to apply for the particular plans. But like I said, January 31st is just around the corner. You don't want to wait till the last minute. You want to give them time to process your applications. They've been inundated probably with a lot of paperwork, so you want to make sure yours is in the pipeline so that when February comes around, you don't have to worry about having that higher payment plan again.